Ever wondered what makes Warren Buffett one of the greatest investors of all time? Wait until the end of the video. The principles will be revealed. From a young age, Warren Buffett exhibited an uncanny interest in making and saving money. Born in Omaha, Nebraska in 1930, Buffett's entrepreneurial spirit was ignited early on with ventures like selling chewing gum and Coca-Cola bottles and delivering newspapers. This interest in business and finance led him to study at the Wharton School of the University of Pennsylvania and later the University of Nebraska, where he graduated at just 20 years old. His appetite for knowledge and understanding of investment principles was further nurtured under the tutelage of Benjamin Graham, the father of value investing, at Columbia Business School. In 1956, with initial capital of $105,000, Buffett laid the foundation of Buffett Partnership Limited. Less than a decade later, he made a move that would define his career: the acquisition of Berkshire Hathaway. And so began the journey of the legendary Warren Buffett, a journey underpinned by a unique investment philosophy. At the heart of Buffett's success lies his value investing philosophy. Let's delve into the principles of this philosophy. First and foremost, Buffett searches for undervalued companies. These are businesses whose market prices do not accurately reflect their intrinsic worth. By identifying these hidden gems, Buffett can purchase stocks at a price lower than their actual value, providing a safety margin and potential for substantial gains. Have you ever wondered about the elusive concept of intrinsic value in investing? Well, today we're unraveling the mystery behind Warren Buffett's investment strategy. Stick around until the end of the video, and we'll uncover the key to understanding intrinsic value and how it plays a crucial role in Warren's successful approach to investing. Strong financials are not the only criteria. Buffett also seeks out companies with a competitive advantage. This could be a strong brand, superior technology, a broad network, or any other factor that insulates the company from competition. Such a competitive edge can protect the company's profits and market share, providing a solid foundation for growth. However, Buffett's investment philosophy is not just about identifying good investments. It's also about patience and discipline. Buffett doesn't jump on the latest hot stock or get swayed by market noise. Instead, he patiently waits for the right opportunity to invest in a quality business at a good price. Buffett is a firm believer in understanding what he invests in. He avoids complex financial instruments and prefers simple, understandable businesses. Buffett's value investing philosophy is not just about buying cheap stocks. It's a holistic approach that combines careful analysis, patience, discipline, and a deep understanding of businesses. It's not about quick profits. It's about finding real value and investing for the long term. Buffett is known for his voracious reading habits and continuous learning. He keeps himself informed about various industries, economic trends, and business strategies, allowing him to make well-informed investment decisions. Warren Buffett is well known for his commitment to continuous learning throughout his life. One example that showcases his dedication to learning is his approach to reading and staying informed. Buffett has a voracious appetite for reading and spends a significant amount of his day absorbing new information. For instance, he is known to read extensively about various industries, financial reports, and books on a wide range of topics beyond finance. He subscribes to numerous newspapers and magazines, and his reading habits are not confined to just business-related material. Buffett believes in the importance of broadening his knowledge base to make well-informed decisions. Furthermore, he has attended various seminars, conferences, and meetings with industry experts to stay updated on market trends and insights. Buffett also values the exchange of ideas and regularly engages in discussions with business leaders, economists, and academics to gain different perspectives. This commitment to continuous learning reflects Buffett's belief that staying informed and adapting to new information is crucial in the ever-changing world of finance and business. His example serves as an inspiration for others to prioritize learning as an ongoing process throughout their careers. It's about seeing investing not just as a means to wealth, but as a discipline that requires continuous learning and understanding. Warren Buffett, a man who turned investing into an art, and his canvas, the world of finance. One of Buffett's most celebrated investments is none other than the fizzy beverage giant, Coca-Cola. In the year 1988, Buffett's company, Berkshire Hathaway, began buying Coca-Cola shares. But what led to this decision? Buffett, being a staunch believer in the philosophy of value investing, saw the intrinsic worth in Coca-Cola. He recognized the strength of the brand, its global recognition, and the company's solid financials. Buffett, being a staunch believer in the philosophy of value investing, saw the intrinsic worth in Coca-Cola. He recognized the strength of the brand, its global recognition, and the company's solid financials. But more than that, He saw a product that people loved and consumed daily, a product whose demand would likely not wane over time. Buffett's investment in Coca-Cola was not just based on numbers and balance sheets. He once said, "I like to bet on sure things. No business has ever failed with happy customers." And Coca-Cola had plenty of those. Since then, this investment has proven to be immensely successful. As of today, Berkshire Hathaway owns a staggering 9.3% of Coca-Cola, making it the company's largest shareholder. The investment that was made at $1.3 billion has grown to a worth of over $21 billion today. In essence, Coca-Cola was indeed a sweet deal for Buffett. It's a classic example of his investment strategy: buy a quality business at a fair price and then hold it, ideally forever. Buffett's investment in Coca-Cola underscores the importance of understanding a business, its products, and its customers before investing. It's not just about the numbers, it's about the value. Moving on from the fizz of Coca-Cola to the innovation of technology, let's turn our attention to another brilliant investment by Buffett, Apple. While Buffett was traditionally known for his aversion to technology stocks, his investment in Apple proved to be an exception. But why did the Oracle of Omaha break his own rules? Simple. Apple, like Coca-Cola, demonstrated strong business fundamentals that resonated with Buffett's investment philosophy. In 2016, Berkshire Hathaway took its first bite of Apple, buying 9.8 million shares. Buffett saw in Apple what he saw in Coca-Cola: a strong brand, a loyal customer base, and a product that was integral to people's daily lives. He once remarked, "Apple is probably the best business I know in the world." And it wasn't just about the iPhones. Buffett admired Apple's ecosystem of products and services, which ensured a steady stream of recurring revenue. The success of this investment, well, the numbers speak for themselves. As of today, Berkshire Hathaway's stake in Apple is worth over $120 billion, making it the single largest holding in the company's portfolio. This investment has yielded a return of more than 100% for Berkshire Hathaway, proving once again the effectiveness of Buffett's long-term, value-oriented approach. In conclusion, Apple was indeed a fruitful investment for Buffett. It underlines the importance of looking beyond market trends and focusing on the fundamentals of a business. As Buffett has often said, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And Apple, in Buffett's view, was indeed a wonderful company. After the innovation of Apple, we now turn to a financial institution that caught Buffett's interest: American Express. This card issuer has been a part of Buffett's portfolio since the 1960s and has proven to be one of his most successful investments. So why did Buffett take a chance on American Express? The reason lies within Buffett's investment philosophy. He saw a company with strong business fundamentals and a robust customer base. Despite American Express facing a significant financial setback in the early 1960s, Buffett recognized the company's intrinsic value. He observed that despite the financial turmoil, people were still using their American Express cards. This was a testament to the company's strong brand and customer loyalty, factors that are integral to Buffett's investment strategy. In 1964, Buffett made his move, buying a 5% stake in the company for $20 million. Fast forward to today, and Berkshire Hathaway's stake in American Express is worth over $18 billion. This means that Buffett's initial investment has grown nearly 900 times over. American Express, much like Apple and Coca-Cola, confirms Buffett's approach to investing. He seeks out companies with a strong brand, a loyal customer base, and a product or service that is an essential part of people's everyday lives. As Buffett has often stated, time is the friend of the wonderful company, the enemy of the mediocre. And with American Express, Buffett played a card that time has indeed proven to be wonderful. From the financial world of American Express, we now venture into the insurance realm with GEICO, an investment that has been a cornerstone of Buffett's success. But why GEICO? What attracted the Oracle of Omaha to this insurance firm? Buffett first encountered this company as a student of Benjamin Graham at Columbia University. Intrigued by the company's business model of direct selling, which cut out the middleman and provided a competitive advantage, Buffett bought his first shares in the mid-1950s. Years later, after observing the company's ability to consistently generate significant free cash flow, a hallmark of a good business in Buffett's book, he decided to make a larger investment. In 1996, Berkshire Hathaway acquired the remaining shares of GEICO, making it a wholly owned subsidiary. The success of this investment has been remarkable. GEICO has grown from a small insurer to the second largest auto insurer in the United States, contributing significantly to Berkshire Hathaway's earnings year after year. In Buffett's own words, "I will tell you the secret of getting rich on Wall Street. You try to be greedy when others are fearful, and you try to be fearful when others are greedy. With GEICO, Buffett saw an opportunity when others saw a risk, and his foresight has paid off handsomely. GEICO, a safe bet for Buffett, stands as yet another testament to his unique and successful investment philosophy. Finally, the secret of Warren's investment success: the determination of intrinsic worth of an investment. In the context of investing and finance, intrinsic worth, also known as intrinsic value, refers to the true underlying value of an asset or investment. It is based on the fundamental characteristics and qualities of the asset rather than its market price or perceived value. Intrinsic worth is a concept often associated with value investing, a philosophy popularized by investors like Warren Buffett. Intrinsic worth is determined through a thorough analysis of the fundamental factors that affect the value of an investment. This may include the company's financial health, earnings potential, competitive position, growth prospects, and other relevant metrics. Discounted cash flow, DCF, analysis. One common method used to estimate intrinsic value is the discounted cash flow, DCF, analysis. This involves projecting the future cash flows a business is expected to generate and discounting them back to their present value. The resulting figure is considered an estimate of the intrinsic worth of the business. For stocks, intrinsic worth is often linked to the company's earnings and dividends. Investors may assess a company's earnings quality, growth potential, and dividend-paying history to determine its intrinsic value. Comparative analysis. Intrinsic worth can also be evaluated by comparing a company's financial metrics with those of similar businesses in the industry. This relative valuation helps investors gauge whether a particular asset is overvalued or undervalued compared to its peers. Economic moat. The presence of a sustainable competitive advantage, often referred to as an economic moat, can contribute to the intrinsic worth of a business. Companies with strong competitive positions may have higher intrinsic values due to their ability to maintain profitability over the long term. Balance sheet strength. The financial health of a company, as reflected in its balance sheet, is a crucial factor in determining intrinsic worth. Strong financials, with manageable levels of debt and sufficient liquidity, contribute positively to the intrinsic value. It's important to note that intrinsic worth is an estimate and not an exact science. Different investors may use various methods to calculate intrinsic value, and there can be subjective elements involved in the analysis. The goal is to assess whether an investment is priced below its intrinsic worth, signaling a potential opportunity, or above its intrinsic worth, indicating a potential risk of overvaluation. Warren Buffett, a legend in the world of investing, has truly shown us what it means to be a successful investor. Hey everyone, excited to share some valuable wisdom from Warren Buffett on how to navigate the world of investing. If you find his advice helpful, don't forget to hit the like button and subscribe to my channel for more insightful content. Your support means a lot. Hit that like button and subscribe to more inspirational contents. Don't miss out.